Welcome to Wednesday's Live. Finish First Financially. Goran Radanovic here. Thanks so much for joining me. I appreciate it. I did start this broadcast at 8 a.m. instead of 7 a.m. Eastern Standard Time. I was busy with my vending machine, so that took up some time. But obviously, I strive for 7 a.m. But business has a mind of its own, and that's just the way it is. So I have to attend to it. Now, today, I would like to talk about investing. I think that's a big topic for many people, although if you're in debt, I'll get to the reason why it shouldn't be a topic for you. But I wrote a book called From Homeless to Debtless with Savings, and that documents my journey of how I became homeless and lost everything, and then how I recovered and got out of debt and saved up a significant amount, $50,000 to be exact. And I wrote a section on investing in that book. Once the reviews came out, some people were saying they were hoping for more advanced investing techniques and options and so forth. And I'm not going to get into advanced investing, but I will discuss investing as it relates to people who are in debt and even people who have just gotten themselves out of debt. I wrote an article on finishfirstfinancially.com called Investing While in Debt, a good idea or not. So we'll go through that article because I think that's pretty much really sums up almost everything that I have to say about this topic. And you'll also hear my story and why I chose the method that I chose to follow strategy, I suppose that you could say. And I think you might get some insights into when is it a good time to invest. I'm not specifically talking about timing the market. I'm talking about your financial journey. So at what point in your financial journey should you be investing? That's obviously up to you to decide. I don't provide financial or investment advice. This is purely for entertainment purposes. And all I can tell you is what I did. And then you decide for yourself if that works for you, if it doesn't, whatever you do with your own life. I only share my experiences, and some people have found that information to be useful. I think there's definitely value in it. That's why I share it, because I always say, if you look at my situation that I was in, I was homeless and I managed to pay off debt and have savings and investments. Well, if I was set so far back and you're in the comfort of your own home watching this, then can you imagine how far ahead you are of me when compared to the time when I was homeless? You're miles ahead of me. So you've got a really big advantage. And it's going to be obviously a lot easier for you than what it was for me, because just for me to get off the street and find a job and kind of regroup, it took a while, and there was a big mental toll that it took on me. It was a big mental toll, but I got through it. It was tough. It was grueling, but it was worth it. That was a big mental toll I took on. That's just life. What doesn't kill you makes you stronger. Yeah. So let's get into the article on finishfirstfinancially.com. Investing while in debt, a good idea or not? I wrote this in April of this year. So I said investing can be a great inflation hedge if you invest in the right assets. The type of investment you choose will be determined by your risk appetite. Usually, the higher the return you seek, the bigger the risk you need to take. Most beginners are concerned about the returns they can potentially make, but they don't ask about other important elements such as, is investing while in debt a good idea? What about the fees involved? You would think that people would be concerned about those. Yet, most are not. They focus only on the returns. Timing is also important. I don't only mean when to enter the market, but also at what stage are you in your financial journey? Okay, so here's my story. After going completely bust, I started to reshape my financial muscles. I lived a minimalist lifestyle, stayed well within my budget, and wanted to invest. Because I lived below my means, I saved money for the first time in my life. Yay! A part of my development was a desire to invest my money so that it could earn me more. The banks offered to pay me about 5% annual interest on my funds, but I wanted bigger returns. I thought that the stock market would provide higher returns, so I studied it to see all the different moving parts. I discovered that certain individual stocks could provide several 100% returns, but they could take years to realize. I sought returns faster. The other option was to invest in an exchange-traded fund, an ETF, that tracked the S&P 500, which has a history of providing average annual returns of 10%. That's better than the bank's offer, but I needed to be certain that I could expect that percentage, more or less. So, with the S&P 500, it's not guaranteed that it's going to be 10%. Could be less, could be more, but it's the average over a period of 10 years, usually about 10%. Once I dug deeper, I discovered that some hedge funds charged high fees for managing the account, which was a passive investment. Their fees would have lowered my returns by 2 or more percent. That might not sound like much, but it adds up over months and years, especially with compounding. So that's important. Always look at the fees with any investment. There's no point in saying, oh, I'm going to get 15% interest or returns, and then your fees are 5%. So you're coming back down to 10%. And there's no guarantee that it's going to be 15%. So just watch out for the fees. That much I can tell you. And you obviously don't want any hidden fees. I mean, that's why it's important to be investing with people whom you can trust, who have a long track record, who are reliable, who've been around for a long time, and the fees that they are charging are reasonable. That's kind of like a guideline. There's no such thing as a sure thing, when it comes to investing, but there's, I suppose, some guidelines that you could follow to increase your chances of coming across somebody who's reliable, I suppose you could say it like that. I ruled out savings accounts and the stock market as potential investments. Well, savings account is a savings account, it's not an investment, but it does earn you interest, compound interests. So as potential investments, and instead I opted for the asset I chose. Okay. So an acquaintance introduced me to cryptocurrency and I became instantly hooked. The returns were huge and fast. Fees were low and there was no intermediary. What more could I ask for? It sounded like I had found my dream investment and returns seemed imminent. I mean, everyone else was making a lot of money from cryptocurrency, so why wouldn't I? I invested most of my savings into cryptocurrency and hoped for the best. Little did I know that the worst was to come. Over the next few months after investing, I watched in horror as my portfolio decreased 90% in value. 90. Yep, 90%. The worst part about the ordeal was that I hoped to make huge gains so I could pay off my debt. Not only did my portfolio's value shrink considerably, but now I had no savings and was still in debt. So you see, my mentality going into this whole investing while I'm in debt is hoping to get great returns so that I could cash out and then I would be able to pay off my debt with those returns and then still have even more savings. That was the mindset. And that's what a lot of people think. They look at the track record of an asset and they say, well, look, every 4 years, it's done a massive bull run, so it's due now that 4 years looks like a sure thing. Let me go for it. This is only bit of savings. So let me take a chance with it. And then next thing you know, it doesn't work out like that. So now they no longer have the savings. The asset's value is shrinking, but they've still got the debt. So if I had known better, I think I've written in the article. So let's check out what I wrote. Okay, so over the next few months, I read that. I realized that investing while in debt was a huge mistake. There are no guaranteed returns in investments, but outstanding debt is guaranteed. A much better decision would have been for me to use the savings to pay off debt. So that's what I was going to say. Yeah, savings, when you use it to pay off debt, that's a sure thing. You've decreased your debt balance. But when you invest money, that's not a sure thing. Nobody can really guarantee you returns. So it's a risk that you take. And if the investment doesn't work out, the debt will still be there, but you're not going to have any savings and your investment's value has decreased. The smart decision I took was not to sell the cryptocurrencies when their value decreased. I waited, hoping that it would return to the value I bought it. The value I bought it at. Eventually it did, but that took several years. Like most beginner investors, I bought an investment asset after it had surged significantly, thinking that I could jump on the spaceship and go along for the ride to the moon. So I was thinking, what happened was at the time when cryptocurrency, when Bitcoin exploded in 2017, and then there were other coins that went up, and we were expecting good news. So it was going to go up even further, even despite it already having done like 1,300%, so, but that's how it is when you're a beginner. You get pulled into that hype and you just think that it's going to keep going up and up, and it makes sense that there's good news coming. So if the good news materializes, if it comes to fruition, then it's just going to keep going. And that's usually not the case. In my experience, what I've found is that once an asset has done its bull run, it's gone up significantly, and then there's good news that comes out. In my experience, what I've seen is that that's usually the top. That's usually what's been proven. And I'm not going to get into this concept of show me the charts and I'll tell you the news. I think that's a discussion for another day. I think we should just stick to investing while in debt. Yeah, that's obviously that didn't prove to be a successful strategy for me. But what you do with your money, your investments is your thing. I'm just telling you what I went through. Okay, so let's get back into it. Most beginner investors buy an asset at the top just before the price crashes or retraces. When the price continues to fall, they believe it can go to zero, so they sell to avoid a total loss. Usually after that, the market turns around and begins to climb back up. So I also mentioned here that I didn't sell when the price was going down. Now, in my case, that proved to be successful. Only if I had sold would I have realized the loss. Fortunately for me, the asset ended up turning around and then went back up to the price that I had bought it at. But that doesn't mean that it's going to work out like that for every asset that you invest in. It just doesn't. It could go to zero. So you need to be careful what you're doing. The rule that I follow with investing is if I invest into something, it's like I've written that money off. Like I can literally part ways with it. And if I don't see that money again, I can sleep easily. It's not going to be a case of, me waking up the following morning to see what the price is. And like, I've got such high hopes for this because I'm going to buy a car with that money, because I'm going to open up a business or whatever it is, or pay off debt. So I no longer do that. I don't do that. I made that mistake once and I'll never do it again. So when is it okay to invest? Well, obviously this is just what pertains to me. I learned my lesson the hard way and discovered that the best time for me to invest was when I was out of debt and had savings for 6 months of essential expenses, which is rental, mortgage, utilities, and food, and a $2,000 emergency fund. If I lost my income, I could tap into I wrote tape, but I mean tap into the 6-month savings account until I replace my income. So that's important. What some people do is that they don't even have, they're in debt, they've got some savings, but they don't even have an emergency account, which is what I'm talking about, the 6 months essential expenses. To me, that was so vital because I didn't want to go back onto the streets again. So as soon as I got some money, I immediately put savings away for 6 months to cover my rent, my food, and utilities, because those are your 3 essential expenses. And most people don't even have that, yet they, investing, hoping to sort out all of their problems. And that's very risky. So, carry on the article. Any savings after covering all those accounts, I could invest only if I felt comfortable losing the entire amount invested. When I consider an investment, I ask myself if I was fine with never seeing that money ever again. If I was, I could invest. Then I wrote that money off in my mind. It's like I had lost it. If I made returns on investment, it was a bonus, but I didn't rely on it to pay off debt or increase my savings. Initially, when I made that first mistake, yeah, absolutely. That was my strategy, to pay off all of my debt and have savings, but not after I made that mistake, never again. Instead of seeking risky assets, I developed a risk-averse mindset, which is avoid risk as much as possible while accepting potential lower returns than risky assets. I found that in real estate. So in real estate, there's some work that you have to do, and it's not usually going to be 1300% returns like with some cryptocurrencies, but for me, it was a safer option. Cryptocurrencies aren't the only risky assets. Even real estate is risky. A tenant may choose not to pay rent, and you need to incur expenses to evict them. The neighborhood could become dangerous, lowering your property's value. Every investment is risky, but some are more than others. You need to determine your risk appetite and the amount you're comfortable with losing. As for me, I can now invest because I don't have any debt and I have significant savings, but I won't invest more than I can afford to lose. I still enjoy having cash. I never know when I might need it. I mean, yeah, cash is king. Cash is king. I always look at my financial journey as like a 3-step process, getting out of debt and then building savings and then investing. But before I've even invested, once I've invested, I don't want to invest all of my money. I want to have a portion of it in cash because I need cash. If I buy land and I need to buy something with cash, I can't. It's going to take me a while to liquidate that asset and exchange it into cash. So the liquidation process for land or real estate is quite long, and I might need money immediately for an emergency or whatever it is. So I always want to have some portion of my net worth in cash because that's very important to me. And also, even if I don't need the cash for an emergency or if nothing crops up, there might be an asset that all of a sudden, is at a bargain price and I need to buy it. So I'm going to need cash for that. That's why a portion of my money is investments and portion of it is in cash. And especially, one thing that where cash is really valuable is during times of recession, because that's when asset prices drop. Most of them do. Stock market crashes, real estate goes down usually. And for me, when asset prices such as real estate and stocks, let's say S&P 500, loses some of its value, then that's the perfect time for me to invest, because I know there's a high chance that those assets will eventually go on a bull run. But for me, investing isn't a short-term game. I'm looking at it from the perspective of 5 years, 10-year period. That's how I look at it. And the chances that you're going to make money from an investment, regardless of what it is, within few weeks or months or even a year, slim. It can happen, but those chances are slim. So that's why, to me, investing is a long-term game. Even now when I got into cryptocurrency in 2017, so now it's been 7 years that I'm still, waiting for returns. That's how long I've been patient, for 7 years. So there are people who have made significant money with cryptocurrencies and other assets, within a shorter period of time. But for me, it's a long-term game, and I can wait so that I can get those really big returns. That's what I'm looking for, and I'm patient. But obviously, there's no guarantee. I could be waiting and waiting, but that's the risk that I'm prepared to take. That's why I said, this is the amount that I put into my investments. It's there. If I realize a profit, wonderful. But I've I've left it at that amount. I'm not adding anymore because I'm not comfortable with losing anymore. Let's put it that way. That's how I feel about it. Okay, so an alternative. The only time I would invest while in debt is if my only debt was a mortgage and my house's value was more than the outstanding debt. If for whatever reason I needed money, I could sell the house, but that wouldn't be necessary because I would have covered 6 months of essential expenses and emergencies. Ideally, the best scenario is to be debt-free when considering investing. That's the thing. If you, let's say I had a mortgage, and would I invest in a 401k? Yeah, I would do that. Especially, obviously, if the employer matches my contribution or a percentage of it, because then that reduces my risk even more. So, would I do it in that situation? I would.